You're listening to Sprott Money's monthly wrap-up with Craig Hemke.
Well, greetings once again from Sprott Money News, sprottmoney.com. It is Friday, July the 29th. It's time for your monthly wrap-up. And joining us is an old friend everybody always looks forward to hearing from. That's Bob Thompson. Bob is a senior portfolio manager, Thompson Investment Partners at Raymond James in Vancouver, and an old friend of our friend, Eric Sprott. So it's great to have him back. Bob, nice to hear from you again.
Good to be on again, Craig. And I think we picked a great time a few days after the Fed meeting.
No doubt about that. The month is sure ending better than it began. Before we get going, just a couple of things to everybody. Remember, this content is provided free of charge from Sprott Money. So throw them a bone if you can. Give them a like, a share, maybe a subscribe to whichever channel you're listening to. But then also with precious metal prices starting to recover and rebound, it might be time to capitalize on that annual Sprott summer sale. It's always one of the biggest sales that Sprott Money has. Great discounts on multiple products, including our best sellers, gold and silver maples. Of course, you can go online to learn more and place an order, but you can also just give everyone at Sprott Money a call by dialing up 888-861-0775. The sale ends August the 7th, so don't mess around. Get there and check it out. Oh, and just one reminder, and Bob, this is probably important to you. August 1 is another Canadian holiday.
We have them about every 2 weeks here in Canada, Craig.
What a great deal. What is it this time, Bob? Is it Moosehead Beer Day? What?
It's create a holiday so everybody gets a day off in the summer, but I think it's called Family Day.
Family. Close enough. I bet there'll be a lot of families knocking back some Moosehead up there.
Absolutely.
All right, my friend. Again, please remember that Sprott Money offices are closed Monday, but that doesn't mean you can't go online this weekend or any other time and check out that great summer sale. All right, Bob. If we'd recorded this call earlier this week, the tone and the tenor might have been a little bit different. We saw what we'll probably look back upon as being the low when the biggest gold miner in the world washed out to some of the lowest levels it's been in decades, down 50% in price in 3 months, that being Newmont, with a daily RSI of 13, which anything above 70 is overbought and under 30 is oversold, and it was all the way down to 13. Regardless, 3 days later, we've got the statements from Powell and quite a reaction in the markets. What do you make of all this as July comes to an end?
Interesting what you say about Newmont there, just to cover that. Been in the business probably 27 years now, and something I've realized over time is that at the end of the day, everything gets destroyed in a bear market. So the big companies hold out, but then they finally get destroyed too, and that's what's happened with Newmont here. So that usually signifies the end of a bear market. So hopefully that's the case this time as we go along. But yeah, it's interesting. I as you know, I did a book a few years ago, and one of the managers in the book, his name was Wayne Deans, and I asked him, I said, "What do investors do wrong?" And he said, "Investors' time frames are way, way, way too short." And the reason I bring that up right now is because it really pertains to this precious metals market, right? We didn't know the Fed was going to start to hint at a 180 or change from forward guidance to data dependent, which they did on earlier this week. But we knew it was going to happen sooner or later. So I've been saying to people, we don't know whether it's this month, the next month, or 6 months from now. Who cares? And if
right.
Your net worth and your portfolio depends upon what the Fed's going to say tomorrow or next month, and you shouldn't be in the market, right? So people should have a longer term time frame than they do. So it just so happened that this time, great, the Fed has relinquished a little bit. They're playing with the market, right? They're trying to say, okay, should we be really hawkish if the market's getting out of control or things are happening that we don't want to happen, and then they'll push the hawkish button again and they'll pull back. But basically, we're in that time frame right now for the next few months where they are going to have to somehow buckle under, right? They won't do a 180 because obviously you lose credibility when you do that, but it'll be a hint here, a hint there, a change of a word, from again, forward guidance to data dependent. And all this means that what we're going to do is we're going to get a rally in gold and silver, because that's what happens. that's the sector that takes off the most when the Fed takes their foot off the pedal. They don't have to reverse 180. Maybe they'll pause a little bit, right?
Right.
This feels a lot like the end of 2018, right? When they were very aggressive, and then they suddenly reversed in 2019, and the gold stocks were up 100%. A lot of the juniors, right? And it happened in 2015, the same thing. So here we are again, 4 years later, and we're back in the same position. So we don't know whether it's going to be this month, next month, or the next month, but I presume in the next few months, things are going to really get a lot more dovish with the Fed, and obviously the market sniffs that out, and we've had this big rally in the last few days. Yeah,
I've been telling people at my TF Metals report site that this from almost exactly like December of 2018, like you said. Everybody was expecting higher rates in 19. All the Wall Street economists were saying the 10-year was going to 5% and all that stuff. But with liquidity collapsing and the stock market down, the Fed kind of signaled that things were changing in December of 18, and then actually put that policy of rate cuts into place by June, about 6 months later. That would put us December, January, something like that. Maybe the Fed starts cutting again. Either way, the COT report, the gold COT report, looks almost identical to where it was at the end of 2018. I mean, there are all kinds of similarities.
That's incredible. The gold COT report and the silver COT report is
boy,
amazing. Boy, you look at that and you're like, isn't it amazing that the bullion banks never lose money, right? Isn't that funny? So when they've got the position they've got now for long silver, we're all on the same side of the trade as the bullion banks, which is kind of where you want to be. Right. For better or for not, or whatever the reason is, that's where you want to be. And I think I should just highlight here, obviously, the gold and silver stocks and gold did pretty well up until June, right? And it's still one of the best performing assets on the year here. If you look at a lot of people don't realize, you look at the US market, that was the worst first 6 months since 1970. So in 52 years. And the interesting thing is, in 2008, if you were half in stock and half in bonds, in long bonds, you kind of broke even. But bonds didn't help you at all in the first half of 2022. I mean, the long bond index was down about 26%, which is incredible for bonds. So, there hasn't been a worse first 6 months for bonds, I heard the other day, since George Washington was president. So I guess they had a bond market then. But it's been pretty incredible, pretty outside of all the norms for every asset class in the first 6 months of this year.
And you kind of figure that's going to change, right? I mean, everybody gets on one side of the boat. That usually means we're close to some kind of turn. And it appears that we have. I mean, we're going to wrap up the week with some solid green candles. And that maybe the miners haven't quite recovered yet as much as the metals have in the last couple of days. Where are we, given all that's taken place, Bob, on that mining clock of yours, that kind of proprietary thing you came up with? I know every time we have you on, people ask, "Where's the mining clock? What time is it? Where are we?"
Well, the mining clock is a great measure of where we are in the long-term cycle. And as you know, I'm a discretionary portfolio manager, but I'm a generalist. I look at the bond market, I look at credit markets, I look at obviously focus on commodities, because we manage money for senior mining executives. And that's why that mining clock is so important from a long-term perspective. So you can gauge kind of where you are in the cycle, because a lot of times in a bull market, it feels really bad, like it has in the last 6 or 7 months. So the bond market, the mining clock has kind of been stuck in neutral for a couple of years now, right? And maybe even backing up a little bit, because we haven't been progressing, because obviously there hasn't been a lot of access to capital for the industry. The market has been very, very focused on the fact that the Fed's going to get hawkish sooner or later. Inflation's rising, and obviously that was going to be a problem for real rates, et cetera. So now that we've kind of come past this, I think we're still around 6:30, 7 o'clock. There was a lot of money raised for the sector a couple of years ago. It hasn't been a lot raised recently, but I think if we get gold kind of pushing the 2000 mark again, we're going to start to get a lot more money into the sector, and that's going to push the clock forward. And what happens in that case, and just as a little review here, at 5 o'clock, 6 o'clock, you start to get cash takeovers of good projects. That actually happened in 2016. It's happening a little bit right now. Then you start to raise money in the industry. That happened in 2020. When you raise a lot of money, we're going to start to get some discoveries, right? And when the discoveries happen, everybody says, "Oh my goodness, this was a 10 bagger, this stock," and more money flows into the sector, which means more discoveries happen. But as more money flows into the sector, looking for great ideas, you kind of run out of ideas as the sector gets a little bit longer. So money goes into kind of, areas where it shouldn't be going into, and money's wasted, and leverage starts to increase. And that's what happens at 9, 10, 11 o'clock. And then the big companies kind of overpay for projects. And that usually signifies that kind of the end of the cycle. We're a long way from that right now. And that's why I still think we're in that buy zone. From 4 to 8, 4 to 9 is the buy zone. We're about 7 o'clock right now. So we got a long way to go. But remember, in commodity bull markets, this is the frustrating thing for people, is that 70-80% of your returns happen in the last 20% as far as time is concerned. Yeah. Right. So we got that ahead of us, which is great. But you just got to be aware that when everybody is euphorically positive, prices are probably way too high for where they should be.
What do you mean? I have kind of a conundrum to ask you about, Bob. It would appear that the Fed will not be able to get Fed funds up above the rate of inflation before having to pause and even reverse. And so that is kind of enshrining negative real interest rates for really the foreseeable future, which is very good, as you know, and most everyone knows, for gold and silver to have negative real interest rates. That's one positive. But, crude oil prices are really sticky as we record this back over $100 a barrel. And that inflation, especially energy inflation, is really hurting the miners with their costs of getting the stuff out of the ground. So there's kind of a catch-22 conundrum there. So what do you make of that? Is there a price that if gold and silver get above, that it kind of outweighs the rising cost to get it out of the ground? Or do we need inflation to come down with steadier prices to make the miners come back up?
Well, I think that, the credit markets always lead the equity markets, right? And let's go back to 2007. Credit markets were blowing up in 2007, but oil prices were hitting, highs. And then even the first part of 2008, before the stock market started to collapse, oil was up at, 120, same as we are now. Then the great financial crisis happened and went down to 30. Oil prices, things are different now, and I hate to say things are different this time, because that's the worst thing you can ever say in the market. But right. we have, and you bring up an excellent point about energy, and I'd like to bring that up, how it relates to mining too. And what we have seen, obviously, is the energy sector is an uninvestable sector, right? It isn't popular to invest in energy. All right. So there hasn't been a lot of capex in the sector.
Right.
And when you don't have capex in a depleting asset scenario, you get elevated prices that are stubborn, and they stay up there, and it hurts everybody. Right. So what it has to do is, if oil prices are going to stay there, everything else is going to have to be elevated. So the gold to oil ratio, gold's going to have to go up pretty significantly to overcome that, which is great. I think it'll do that. Now that the Fed's turning. Once you get over 2000, I don't think anybody really cares. Companies are making a lot of money, right? But I think what's important here is that, I always like to look at the past and look at history, because again, history doesn't repeat itself, but it rhymes. Look back 20 years ago, 25 years ago, when there was social, or 30 years ago, actually, when there was social and political barriers to a sector, or pressures on a sector. That sector was the tobacco sector back in the mid 1980s, right? I mean, how many people smoke now compared to how many smoked at that time, right? So you look and you say, what a horrible sector to invest in. I mean, political pressures. I mean, people, you looked at the packages of cigarettes, and there was like rotting teeth they put on the packages, right? To discourage people from smoking and things like that. How much more could a sector take? Now, interestingly enough, when you put that pressure on a sector, you actually create a barrier to entry for that sector, and you create a moat around that sector. So from 1988 till 2008, so 20 years, the best performing stock on the Toronto Stock Exchange during that time frame was Rothmans, which was a cigarette maker. It was up 12,000%. In that time frame, when the social and political barriers were just enormous on that sector. Now, interestingly enough, for all the US listeners, we've had a lot of big wins in the US, Microsoft and Apple and all these stocks that were not even around many years ago. So everybody thinks, oh God, they must be the best performing stocks. The best performing stock on the New York Stock Exchange was Philip Morris during that time frame also. Yep. Right? The dividends, the stock buybacks, right? So I think in energy, that's kind of, they've created this artificial barrier to entry for these energy companies. I wouldn't be surprised to see these energy companies just cash flowing huge amounts of money. Now let's extend that a little bit further. Mining is kind of right behind energy, right? I mean, nobody likes to see a big hole in the ground and an open pit and all that sort of thing, right? So I think what can happen is if you create these barriers to entry for these sectors, this just could be immensely profitable for oil and gas and mining going forward. If there's some differences between tobacco and oil and gas and mining, but there's some similarities too. So I just wanted to cover that. I think that's really important, looking out over the long run.
Well, there's that ESG stuff too.
Eric spoke at the PDAC in 2020, and he started out his talk. He said, I strongly believe in ESG. I'm a big ESG proponent. And then everybody's looking at Eric and, of course, wondering what he's going to say. And he said, of course, in my world, ESG stands for exploring for silver and gold. So anyway, it's great. I always remember that story. But yeah, ESG's, obviously it's going to put pressure on a lot of industries over time, but it might have the reverse effect of what we think is going to happen. The other thing is, I heard of a company the other day in Chile that was, basically they've spent all this work and millions of ounces of gold, and they're ready to start not going into production, but thinking about creating a mine. And the Chilean government basically said they weren't happy with the company's plan to relocate 20 chinchillas. So basically, they stopped the whole plan. Hundreds of millions of dollars in this plan, stocks down 80%. So so what we might have in the next few years is we might have gold go through the roof, and we might have copper through the roof, and all these commodities that have gone up a lot, but the juniors really haven't. There's going to be winners, but it's going to be really hard to create a mine with all these ESG processes in place.
And maybe that's why the GDXJ chart, just looks terrible.
Mm-hmm. It does. It's interesting, and you look at it. It was $160 back in 2011, and here we are at in the low 30s. So I do think that and I do think that's we'll see that rise absolutely significantly, but we're going to have to be led out of it by a higher gold price and a higher commodity price. And I think commodity prices will go up more than they normally would have because of all these ESG concerns, et cetera. And that's going to pull all the stocks up too. So,
Bob, just as we begin to wrap up and look forward to the month ahead, Powell has basically told everybody that data dependency part, like you said. It was really interesting. He said, we have moved expeditiously to the neutral rate. In the past tense, implying that they are now at a neutral rate. Mm-hmm. And now we are going to be data dependent going forward. We don't have another Fed meeting until the end of September. Mm-hmm. August, a month where a lot of people go on holiday, so liquidity kind of dries up. We're going to be data dependent. We got the jobs report next Friday. Powell will be at Jackson Hole by the end of the month. And so that'll be an interesting signal. But will you be watching? I know you don't get into the technicals too much. But as you observe price, are there other indicators you'll watch now going forward that'll make you feel confident that the lows are in, the worst is behind us?
Yeah, I think so. And, we all knew, 1675 was kind of the big support for gold. Yeah. And it kind of got down around that level, and the same for silver in the mid 1800s. But I don't look too closely at that, because I just look and say, hey, if I want it to keep going down, as long as I'm putting in more money, because I'm a lot more longer term investor, right? If you're worried about catching the bottom, then you worry about that sort of stuff, which is fine. But I just think I pay a lot of attention to sentiment, right? And it's funny on Twitter, right? You see all the bots and everybody coming out and saying silver's going to $10 or whatever, and that really exploded in the last little while. That's one of the best indicators you could possibly have. And when you get to that point where sentiment is so terrible, it's a really a real asymmetrical return profile from that perspective. Asymmetrical return profile means your downside is 10%, 15%. Your upside is hundreds of percent in some of these stocks, right? I'm not saying that's going to happen, but obviously that, mathematically, you're skewed to make money, right? Your maximum you can ever lose on a position is 100%, but you can make 500, 1,000%, right? And I know I've mentioned this before, but that's something that Eric always said about the mining sector. He said, I love it because the lows are so low, the highs are so high that the difference is 1,000%. And that's not the case in any other sector, right? So this is the time where you just get greedy and you say, oh my God, everybody's on the one side of the trade. Sentiment is so terrible. My downside's very small and my upside's very, very big. And if I could just take 30 seconds here, Craig, one of the greatest invest money managers ever, Stanley Druckenmiller, right? And him and the Quantum Fund, they kind of broke the Bank of England, as they say, in the early 90s. He went to George Soros for the trade and said, because of the European exchange rate mechanism, I think the pound's going to drop a lot. I think our downside, if we short the pound, is maybe we lose 3%. But I think our upside is 15 to 20%. That was a perfect asymmetrical return profile. And that was just because of the structure of the market at that time. Soros said to me, he said, that's probably the best trade I've ever seen. How much of the firm's capital do you want to put in? And he said, Druckenmiller said, I knew Soros kind of swung for the fences. So he said 100% of the firm's capital. And Soros looked at him. He said, you haven't learned anything. I told you this was the best trade I've ever seen. Put 200% of the firm's capital into it, right? So they made a lot of money. But I think that's the important thing is, and Paul Tudor Jones has said that he's made the most amount of his money at the extremes, at the euphoric extreme and at the absolute worst sentiment extreme. And that's right now. That's when you get the asymmetrical return profiles. Right at this time. And again, we don't know whether it's going to be this month, next month, or the next month, but we know that when, the economy is cratering, the economy can't take these interest rate increases like this, and they're going to have to reverse course at some point, and that's when things explode on the upside.
And that's the way it's worked in the past. I just might direct everybody, while you're at sprottmoney.com, check the Insights tab. There are articles each week from that I write and that David Brady writes. David wrote a great one. It was posted, I think, yesterday, about where we go from here. And I wrote something back on Tuesday with some of the recent history of when gold has rallied as the Fed has tried to catch up. And the last three rallies have been 30%, 30%, and 50%, all in 6 to 8 months.
And you can double that with silver,
easy.
Right?
Yeah. Mm-hmm. Oh, yeah. And silver was double that. Mm-hmm. And like you said, when everybody's on one side of the boat and so bearish, that's the time. And you mentioned the bullion banks too, Bob. Everybody recognizes that, if you follow the metals and you watch the commitment of traders reports, when you get all the specs in the hedge funds long and the banks are heavily short, everybody just rolls their eyes and goes, oh God, here it comes. They're going to smash price. But nobody wants to ever think that it goes the other way when the speculators are all short and the banks are long. It's like, well, boy. And that's exactly what we've had. I would think you probably see this the same way. The last couple of days, as sharply as silver's moved up, it's probably a major short covering rally to begin with of those hedge funds.
Yeah, and every great bull market starts with a short covering rally because it comes off that capitulation and puking, which is what we've seen. And interesting enough, the gold COT was great. The silver COT was absolutely phenomenal. But another COT report, and I mentioned this because Sprott Money sells platinum, was the platinum trade. It looked very similar to silver as far as the CO2 report. Right. And obviously Sprott Money sells platinum. So
there you go. While you're at sprottmoney.com, check out, I'm sure there's some deals in the summer sale in platinum. I don't know a single ounce of platinum, Bob. What? Maybe I should. It'd be kind of fun to have. Yeah,
it is. I bought a few ounces and it kind of, it's this grayish metal. So it looks very similar to silver, a little bit, quite different than gold. And you remember platinum used to be double the price of gold years ago, right? Yeah. So
and maybe I can quiz friends when they come over and hand them a coin of platinum and a coin of silver and see if they can tell the difference.
Yeah, there you go. That's right.
All right, Bob. Hey, before we go, again, your day job is you're a private money manager at Raymond James in Vancouver. I would imagine some Canadian citizens would love to get your take on a few things. How can they contact you?
Sure. We actually do a report called The Gold Digger. And
Oh,
the
that's
gold
right.
diggers, yeah, and
Yep.
that's mainly made for mining executives with concentrated equity positions in mining stocks. But we talk about the markets, put this interview in there, etc. So yeah, it's the gold digger, and it's probably coming out again next week. But you can email Thompson, THOMPSON investments at raymondjames.ca.
There you go. Thompson Investments at raymondjames.ca. And yeah, definitely get on that mailing list. And I love the name. I think that's a fantastic kind of play on words. I think it's fantastic.
Excellent. Yeah.
Bob, you're the best. It's always good to hear from you. And we very much appreciate all this input. I hope you have another 3-day weekend. Can you tell I'm jealous?
It's terrible here, Craig. Yeah.
That's just awful. You're in Vancouver where it's beautiful and you get a 3-day weekend. Anyway, thank you, Bob. And hopefully we'll have to make sure we visit again before we get to the end of the year, because I'm sure there'll be lots more to talk about.
Sounds great, Craig. Look forward to it.
And thank you, everybody, for listening. Again, visit sprottmoney.com for that Sprott summer sale. And be sure to check back all through August for more great content from Sprott Money. Have a great weekend, everyone.